I just raised my S&P target to 7,500 from 7,000. I think we could be there this year. I raised my target on gold. My new target is 3,400. I think we could be there in the first quarter. Very, very much think that's likely. Big run up here, correct? And then, my target for end of this decade, early next is 20,000. Gold is obviously more of a monetary metal. It certainly is. A lot of it is, world events. A lot of it is the dollar. A lot of it is, some place where you can get away from concerns about inflation, et cetera. Silver, on the other hand, has much more real cyclical exposure to, solar panel markets and EV and lots of other things. So there's more of a cyclical component to silver. But right now, I think there's plenty of demand for silver cyclically, and silver has that other component, which is it is poor man's gold. So it's not a pure monetary metal, but there are a lot of people that will run to silver when gold's getting a little bit expensive, and you get more bang for your buck, it seems, or it's like stock splits. You're able to buy more of it if you can buy it at 30 something, and gold's at 2,700. But the simplest way to put it in terms of, as I see it anyway, in terms of gold versus silver, is that in bull markets, silver will outpace gold typically. So that gold silver ratio, which was up around 90, a year ago or whenever, should get down towards 40. If gold divided by silver gets down from 90 to 40, that tells you silver's way outpacing gold, right? So in a bull market, you want to be probably more heavily weighted in silver. And then in corrections, or when we go through the pullbacks in these metals, particularly during the bust, if you're going to own either one, I'd probably own gold, and then on the other side of the bust, they're both going to be skyrockets, and it's personal preference as to where you want to be there, but silver will probably outpace.
Now, when we're thinking about the broader bust here, though, where do you think the transfer, or I'm maybe projecting here, maybe there isn't, but do you think, maybe is the best way to phrase it, do you think that there's a transfer of capital from equities into metals? And if so, where's that relationship? When does that start to happen in droves?
Yeah, the biggest time, silver will probably get hit much harder than gold in the bust. So gold will outpace equities during the bust. If I'm calling for an 80% bear market in the stock market, in the U.S. stock market, and I say gold could drop back 35 to 40%, obviously that's a much better place to be than equities if you had to be somewhere. Silver, on the other hand, if it goes to 75, it could easily come back to 30, or maybe even back into the low to mid 20s, because it is so cyclical. And if we go through a worst economy, worst financial situation we've had in post World War II era, you're going to see big hits to things like silver. So silver is not something that's going to protect you on the downside in a bust. The bigger story, which is I think what you really want to know, is the post-bust era, when we're coming out of that bottom and the Fed's printed so much money. It is going to be a cycle where commodities of all kinds will far outpace the equity markets. And it'll be a high inflation environment. Ultimately, it'll start out slow, but in the decade, we could see 25% inflation. I expect gold and silver to be leaders of the pack in terms of performance leaders, outpacing almost everything else at the end. But during that commodity cycle, you can have, as I say, if the stock market drops 80%, so let's say, it was easier math when the S&P, my target was 7,000, and I'd say you can go down 80%, that's 1,400. But from 7,500, let's say it's 1,500, I don't know what it is. You can triple that number and be at 4,500 or 5,000, and still be way short of that 7,500 cycle peak this year. Obviously, my numbers are just my guesses, but so you can have a cyclical bull market that will never come close to the peaks of this cycle. On the other hand, gold and silver and copper and oil and ag commodities are going to see highs many-fold beyond anything they've ever seen before, because it's going to be driven by all that money. It's going to be an inflation cycle. And so natural gas might get down to $1 in the bust. Who knows where gas goes next cycle? Natural gas might be $40 or $50 next cycle. Go from $1 to 40 or 50. That's 40, 50 times. Gold going from, let's say, 2,500 to 20,000. That's a huge run. Silver going from, let's say, 20 to 500 is my target in the next cycle. So those things will outpace. Oil will go from, let's say, 30 to 500. And meanwhile, you've got maybe, you can have a couple of years where the equity market is still, it's not keeping pace with other things, but I mean, it's not going to be what the commodities are through that whole cycle. But for a couple of years, it might be a pretty good place to be. But then what you're going to run into is the headwinds of higher rates. If interest rates can, interest rates will track inflation. If inflation can go from deflation next year to 25% inflation by, let's say, 2030 or 31, then interest rates are going to go from, I have said, I expect the 10-year to be down to zero next year in the depths of the bust. You could go from a 0 10-year to 15 or 20% 10-year by the early next decade. So if you have interest rates doing that, that's a huge headwind for the stock market, because PE multiples are the inverse of rates. They move inversely to interest rates. So that's really what drove the last 40 years, is we had interest rates go from high double digit in the early 80s down to almost below 1% in 2020. So you had PE multiples go from single digits to 25 or 30. And that's, we're going to have the reverse of that post-bust, because it's going to be a huge inflation cycle.
A curiosity I have with respect to the bust is, normally when we see markets go through these larger corrections, even to bear markets, extended bear markets, normally there are still elements of strength, either in markets, commodities, somewhere. Do you see anything showing strength at all during the bust, or is this literally everything is coming down together, just in different degrees?
Two things. One, treasuries. If I'm looking for a 0 10% in the bust, and let's say it gets to 250 before the bust, there's still a big run up in the treasuries between 250 to zero. And short rates will go below zero probably. The long bond will probably get down to a quarter or a half. So that will be one asset that will not only not be going down, but will be going up while everything's falling apart. So that's the number one asset in the bust, in my opinion. And why? Because of the government guarantee, because of the printing press. As I say, in the 2030s, when all collapses, it won't be the same story, because you won't have the government guarantee won't mean much, because the government will be bankrupt. But in this, because of the printing press, I think you can pretty much be assured that they'll honor all those treasuries. So the treasury is first and foremost, and the only other asset I come up with is the dollar, and not from here, but from that 82 at the lows or wherever it goes to. If it can go back up towards 120, you got two appreciating assets, and the rest of the asset structure, whether it be private equity, whether it be leveraged loans, whether it be corporate bonds, and particularly junk bonds, whether it be the stock market, whether it be commodities, they're all going straight down. So having your money in either an FDIC insured savings account or a treasury bond, or any treasury security, any maturity, or the dollar, those are about the only things that will, I think, protect you.
I see. Last question before we wrap up is, obviously your thoughts are that we're in the melt up now. It's likely to hit a crescendo, either towards the end of this year or Q1 next. What are some of the warning signs as far as you can see now of when we're in the melt up? What does it look like when the melt up is slowing and starting to show cracks?
Yeah, I think what you're going to have is an all-in market. So right now, as I say, people are starting to raise. I'm just looking at Wall Street strategists, for example, they're starting to raise targets. You've seen a couple 6,000 numbers out there lately. I was the only one for 2 years. I mean, people thought I was crazy. But now you're starting, as you're getting closer to it, you're starting to see the numbers raise. And so, people who had targets of 51 or 5,200 6 months ago now are talking about 57 or 800 or maybe 6,000 for a couple. As we move along here, you can see those targets raised. You're going to start hearing more talk about this has legs, that it's not just into the end of the year, that because of the Fed, because we're starting a new easing cycle, that this might run for a couple of years or longer. That's what will capture the institutional investors' attention, is if they think this isn't the end of something, it's the beginning of something, where they can discount the earnings out a couple of years, that are high earnings out a couple of years, and maybe even longer. Their models will now be able to make sense of this where we are, because they've been struggling with the valuation and saying, there's not much room left. This thing is going to come to an end here shortly, and we don't want to be buying the top. If they really believe this is the start of something, you'll see them ramp up. And that's why I think you're going to see the whole final move happen in 2 or 3 months or less. It sounds crazy to say you can go from 5,900, 58, 5,900 to 7,500 in between now and the end of the year. Except if everybody comes to the same conclusion that, the Fed is actually really easing, that the economy isn't strong, that there's a cycle ahead, they'll act on that in a short period. They're not going to wait months to act on that. So you can get that parabolic final run. That now, of course, they're not going to be looking for a bust. I'm looking for a bust. They're going to be thinking the cycle's just getting going. What you'll be looking for from a stock market standpoint is everybody being bullish, everybody being all in, everybody having that bullish narrative that says this has legs and it can go for 2 years or 3 years. When you hear people saying it's Goldilocks and you've got, earnings are moving up, interest rates are moving down, inflation's under control, the Fed the Fed managed this perfectly. Those are the pieces of the narrative that I think will tell you're getting close to the end, from a stock market standpoint. From looking for signals of the other side, it's going to be tricky, because if we're up on stilts, it's people aren't stupid out there. If they see the signs that things are getting bad, it won't be up on stilts. But I think initially, weaker economy slowing, because I'm still in the camp that says the recent strength is kind of a facade, that basically, yes, we're getting a last hurrah in consumer and things, but there are cracks showing underneath, and the labor isn't as strong as those numbers indicate, et cetera. So I wouldn't be surprised in the next, between now and the end of the year, if we start getting some signs that things are moving closer to recession, or aren't as strong as we thought, and recession's looking more likely. But that's not necessarily going to be received bearishly, because it means the Fed's going to have to get more aggressive. So when it turns into more bearish is when it turns out it's not a soft landing, it's not a mild recession. It's, oh wow, things are really deteriorating fast. We almost had that in July, right? We had some numbers there that surprised us to the downside, and it looked like it was speeding up, and then we caught our breath again, and we got a little more strength. I suspect before the end of the year it's going to go back the other way. It'll be received initially bullishly, and it's only, I think, as we get into early next year where the number, what you'll be looking for is the numbers to start really accelerating to the downside, whether it be, ISM numbers, retail sales, um, housing, because I think homes are kind of getting a last hurrah because those that felt they missed it are getting a reprieve because rates are coming down, mortgage rates are coming down. But they're buying almost too quickly because rates are going to come further down, but there won't be more buying power behind that because those that wanted to buy now are kind of jumping the gun now. And soon after this, it's going to be, there's more inventory. There's not another wave of buyers. And all of a sudden, the house price starts slipping. I think that will be one of the early signs that, next year is not going to be what this year was. Yeah, the only thing I would say, just kind of furthering out
Yeah.
the talk about the bust, is people just have to remember the melt up seemed crazy at the time too, and people fought it and fought it and fought it until now. Now people were throwing around the term melt up, but for 2 years they really thought I was crazy for thinking the market could do anything like it's done. The bust, people want to be able to see it. They think now they're starting to question, isn't it possible you're dead wrong on the bust? I say, yeah, it's certainly possible, but
Sure.
my convictions are still high that that's where we're headed. But don't expect that it's going to be obvious that you as a retail investor or even you as an institutional investor, not you but anybody,
Sure.
um, that it's if it were obvious, we'd be acting on that now. So it's not going to be obvious for a while yet. Don't use that as the sign that we're not going to have one, because it'll all of a sudden show up. But I think we've still got, between now and the balance of this year for sure, plenty of room for this thing to run, and bust type signals are just not going to be there.